Hi, Jeff.
Yeah. Hey, how you doing, Art?
Good.
It's interesting, and I'm a novice when it comes to this whole process of what causes what to go up and down. Although I'm much more in tune to it now, being on this side of the camera and listening to all your wisdom. But typically, I see if the stock market goes down, I kind of see the bonds kind of recede. In other words, the potential interest rates go down. But today I see the stock market is down and the bonds are up. Is there a correlation with that?
Well, yeah, that's an interesting observation, and there's something to that. There's a concept in the markets, certainly in the mortgage industry, and as we watch the financial markets and the stock market and the bond market and so forth. Of course, the stock market doesn't have really any direct correlation to mortgages at all. But what can happen is if you see a stock market that is selling off substantially, and of course, there's still predictions that we're going to have a pretty good correction coming up at some point.
Mm.
Well, when something like that happens, barring any other economic news or data points, what you can see is what we will call a flight to safety. We'll see money coming out of stocks and going into bonds. You put more money into bonds as a safe haven, that's going to drive bond yields down. So at times we will see that flow of funds phenomenon if the stock market's selling off and money's moving out of stocks into that safe haven of bonds. But that doesn't always occur like today. Today, I think what's going on is the ISM Services Index came out pretty strong, which normally you would think, okay, that should be good news for stocks, right? The economy is doing well. But
Yeah.
you've got to consider at any given time, there's a certain mentality in the markets. And remember, we don't have it on the slide now, but very often in our initial slide, we'd say on financial markets, they respond with reptilian-like minds to stimuli. So that changes from time to time. And right now, today, I think what's going on is that services index came in pretty strong. While that's otherwise good news, the markets are saying, well, wait a minute. If the economy is actually doing that well, then that's going to diminish the chances the Fed's going to lower the Fed funds rate further and frequently. So I think that's really what's going on. It's like good news, bad news. Okay, it's great news. Economy's doing okay, at least on the services side. Again, manufacturing, not so much. But good news on the economy, as we know, can be bad news for bonds and mortgage rates. And so in this case, that's what you're seeing is the stock market's going, oh, we don't like it this time because it's hurting our chances of getting rates even lower.
It's wild because it's like I feel like I'm in the stands watching a football game, but I'm rooting against my team because I've bet on them losing and I'm covering the spread.
Well, that's why for years I've told prospective mortgage borrowers that unfortunately it generally is true that if you're looking to get better rates, you want to almost root for bad economic news. And it's unfortunate to say that because you don't want people to lose their jobs and be out of work and all that. But there is a pattern there. And of course, there can be other things. We haven't talked much about this, but international events can be a big factor. There's a lot of turmoil in the world right now. And if something really, really significant and bad happens, we could see a real flight to safety. The stock market could really, drop considerably, and money could go into bonds just because at an international level things are getting way, out of whack and way too much turmoil. And so even that could be a factor at some point. So we have to keep that in mind as well. So.